Yeah, we are live. Namaskar and a very good evening to one and all. I, CA Deepak Chopra, Chairman Direct Tax Committee of Karnataka State Chartered Accountant Association, welcome you all to yet another session under the KSCAA series Ask an Expert. In today's session, we will deliberate the latest amendments and challenges in Form ITR 7 and the new tax audit reports applicable to charitable trusts. To do so, we have with us today CA Rani NR. Madam, hearty welcome.
Thank you, Deepak.
A quick intro of Madam before I hand over the proceedings to Madam. So, Madam is a fellow member of the Institute of Chartered Accountants of India. She has been a partner in G. Ananta and Company, a Bangalore-based firm of chartered accountants since 2004, and has garnered experience of more than 15 years in the areas of statutory framework relating to not-for-profit sector and for-profit sector. Prior to that, Madam worked with E&Y for about a year. In addition to regular practice in the areas of audit and taxation, Madam's area of specialization is in international taxation, for which she has completed the certification course from ICI Bangalore and also is a diploma holder in international taxation from ICI. She has also authored a book on international taxation and co-authored books on transfer pricing. Madam also has a master's degree in business law from National Law School, Bangalore. Madam has spoken at various fora, including branches of ICI, Direct Tax Regional Training Institute of Income Tax Department, on matters relating to income tax and international taxation. With this very brief introduction, over to you, Madam.
Thank you, Deepak, and thank you, KSCAA, for this opportunity. Good evening, everyone. So today's session, we are going to look into the uh, requirements of reporting in the income tax return, form number 7, and the audit reports applicable for the organizations having the approval as charitable organizations, those who have been approved under the Income Tax Act as charitable organizations. So before getting into the forms as it is and the topic today, I thought it's a good idea to get a basic understanding of the environment and basic understanding of the requirements of these organizations, which are called charitable organizations, and why most of the reporting requirements in the income tax return or even the audit report, we will be able to understand and appreciate as professionals if we can understand the context in which these organizations are getting approved, or what is the mandate for these organizations, and what is the premise under which the department, the statutory authorities are giving them specific income tax exemptions and benefits. So uh, these organizations are called charitable organizations, and for the purpose of identifying the charitable activity, charitable purpose is defined under the Income Tax Act under section 2 subsection 15 of the Income Tax Act, which includes education, medical relief, relief of the poor, preservation of environment, then preservation of this archaeological historical important items including yoga, and there is a last limb of the definition which includes any object of general public utility. So if any of the organizations are not carrying out any of these precise activities, if they carry out any activity which in general the public is the beneficiary, then such organizations are also given approval as charitable organizations if the income tax officer is convinced that the activity will be benefited to the public in general. And the basic premise of these organizations being charitable organizations are they are not carrying out the activity with the intention of making profits and declaring dividends. So the people associated with these organizations either the trustees or the board of directors, or in the case of a society, the members who are the governing people, or even the founders. They themselves are never the beneficiary of the output of these organizations. So if you understand a simple way of the way it works, there is no quid pro quo element at all in the way these organizations work. That is the premise. So there are always the assumption is there are three parties involved in the transaction. There is a person who is a donor or a grantor who is willing to utilize money for the benefit of public or a section of the public for he or she or an organization is willing to deploy the money for that purpose. That is the donor or the grantor. Now the second person in the whole scheme of thing is the actual person who is willing to do the activity, who is the person who is willing to execute the activity. That is the second party in the whole scheme of things. And the third is the public or the beneficiary who will enjoy the benefit of this both money and the actual work. So the terms what we use in our common discussion is, in my example, the first person who is willing, the person or the organization who is willing to apply the money for the benefit of charitable activity is the donor or the grantor. And the second person, the second party is the organization with whom we are dealing with today. The organizations who are actually utilizing the money given by the grantor or the donor for carrying out the activities which fall within the definition of the charitable purpose, and the beneficiaries are definitely the people who are neither of these two people. It is a third party, which is largely the public, because this we are talking today, the topic is precisely for public charitable organizations. So the beneficiaries should be general public, uh, not a private individuals or private parties. Now, to do with this context is very important, because many of the amendments or the mandates based on which these organizations have been given approval, or the reporting requirements either in income tax return 7 or in our audit report for these organizations, if we are able to understand this basic principle based on which these organizations work, we'll be able to appreciate and understand, and more important, apply our judgment. Because from my very limited experience, many cases we don't get a straightforward answer when we are dealing practically with situations by applying the rule as it is. There the judgment plays a critical role, because we have to file the returns within the due dates and we have to file the audit reports. So to apply the judgment, of course, the judicial precedents are helpful, but as always, the judicial precedents sometimes will have contextual decisions. So these judgments for taking a decision in a critical situation, this basic premise and the basic mandate and the basic requirements of these organizations, that understanding is very helpful. So given that requirement, I thought it is better to start with the basic requirements. So charitable organizations, as I told you in my example, the second person, the organizations can take the form of any entities. It can be a trust, it can be a society, it can even be a company under the Companies Act. With us, it is actually a private limited company, but they are different because they get a separate license under the erstwhile section 25 of the Companies Act, or the present Companies Act 2013, section 8 of the Companies Act. They have to apply for a specific license and get a license to conduct themselves as a charitable organizations. So basically, they are not for-profit organizations. Now, going forward, to conduct these activities as charitable organizations and to recognize themselves as charitable organizations, they need to seek an approval from the income tax department to recognize themselves as these organizations and thereby enjoy the income tax exemption, because the idea is to utilize even the money for the general public. No independent third party or no independent private party is enjoying the benefits of the activities. So there are specific provisions under section. So the sections which are relevant for these organizations are section 2 subsection 15, as I told you. Then of course 2 subsection 24 includes definition of income, includes what can be the income for these kind of organizations. Then section 10 subsections 23, lot of subsections are there which are relevant for these organizations which are carrying out these activities. Then section 11, section 12, section 13, these are critical sections where they discuss about conditions based on which the approval is given, the procedure for application, and also what are the mandates and what are the requirements. So these organizations, now what are the different revenue streams? Unlike a for-profit organizations where we are familiar, where the for-profit organizations common revenue streams will be sale of goods or rendering of services, which can be falling in different categories. Basically, there is a quid pro quo element. As I told you, there is a demand for goods or services, and there is a supplier of services or goods, and there is a quid pro quo. The person who renders service or sells the goods will sell the good or render the service, and the recipient will pay the money. In the case of these organizations, predominantly or generally, there are specific cases, we are not discussing that here. Generally, these kind of organizations, the primary revenue streams will be in the nature of voluntary contributions. When I say voluntary contributions, these organizations cannot insist on somebody. If somebody has promised, say an individual has promised a trust carrying a charitable activity that they will give 10 lakh rupees as donation. Now, the trust can write a proposal. First, what happens? They will tell what they are doing, and the donor will get impressed with their activity, and the donor will promise them to pay a donation or a voluntary contribution of 10 lakh rupees. Now, after some time, if the donor is not willing to pay, or he is not making the payment to the to trust or this charitable organization, they cannot go to the court of law insisting the donor to make the payment. They have no right of enforcement. Why? Because there is no rendering of service or rendering of goods to the donor, in respect of which this, so there is no concept of that consideration as far as the voluntary contributions are concerned. So that is why it's called voluntary. The person is deciding to give the money voluntarily to these organizations who is carrying out the charitable activity. It can be in the form of corpus donations. It can be in the form of general donations. It can be in the form of specific grants. These are generally the nature by which voluntary contributions are received by these organizations. Now let us understand what is a corpus donation, very, very critical. So if somebody makes a donation to an organization saying that it shall form part of the corpus of the trust or the company or the institution. What is corpus? It is like the share capital. It is something like a kind of, can't say it is share capital, but it is like a fund, a corpus, a property of the trust of the charitable organization, where they say that that money what is given should not be as it is deployed to conduct the charitable activity. That can be kept as a fixed fund, and the earnings out of that fund has to be invested in specified modes. The act is very precise what they have to do with such corpus donations. There is a separate section for corpus donation 11(1)(d), and also the modes in which the money can be deployed. Also, there are specific sections, and also the violations has implications. We will come to that. So this corpus donations is so critical that the recipient organizations get the money with a specific direction from the donor that it should form part of the corpus of the organization, of the institution. The documentation should be very clear, and the corpus as it is should not be used for the activity. Usually the income generated out of it will be utilized for the activities of the organization. These are corpus donations. Very precise documentation is relevant, and the organization, the recipient organizations, they themselves cannot designate a donation as corpus donation. The donor himself should insist that it is a corpus donation. Next is general donation. It is like somebody like the activity of an organization. Say, look, I have seen your activity. I'm seeing that you are doing a lot of good job and I like it. So I like to participate in your activity, or rather contribute to your activity. So look, take this money. Do whatever you want. Make sure that this money is utilized for your activity, for the objectives of the organization. That is called general donation. There is no specific insistence from the donor as to keep it as a corpus. Such donations are called, generally the common term used is general donation. Then another category which we come across in the voluntary contribution is specific grant. So specific grant is where the donor is very clear. The grantor is clear. The grantor has an agenda, or I should say agenda is a wrong word. The grantor wants to utilize the money, or he has money which he wants to use it for a cause which is more precise, not a general cause like preservation of environment, or say protection of wildlife, or feeding the poor, or educating the poor. Like that, there is this precise aim for the donor, and they identify the organizations which are carrying out the charitable activity in that particular area of activity, and they will tell that, see, we are grant giving organizations. They generally they are called as grant giving organizations, philanthropic organizations. They that look, we are philanthropic organizations. We have this funding. We want to give the money for the activity which you are doing. Now the recipient, the organization, the charitable organization is supposed to write a proposal. This is how the whole process happens. They will write a proposal saying that these are the ways in which this is our plan. Say you want to do cleaning of Bangalore lakes. That is your agenda. Now this is our proposal. We will be able to execute this program. There are so many lakes in Bangalore. We'll do a study. We'll do a survey. We'll find out the extent of pollution what has happened, and they will do statistics, and they will tell that this program can be executed over a period of 3 years, and this is the budget for the expenditure. Like we need so much salary, so much travel, and so much field work, all those things, and the organization will write a proposal, and the donor organizations will give a grant, and accordingly the grant money will be executed according to a grant agreement. So the document in support of that is usually a grant agreement with a budget line and timelines for reporting, and utilization reports have to be submitted by the organizations to the donor, and the deployment fund also happens in installments. It is very relevant to understand this because in our form ITR 7 there are separate reporting requirement of various types of grants, and various, say for example, there are grants has been classified as grants from government, and we know, we are all familiar with companies requirement, the requirement under the Companies Act for CSR grants, where they have a corporate social responsibility requirement as per the CSR rules, and companies will give CSR grants to this organization. So in ITR 7, one of the reporting requirement for the charitable organization is to identify and categorize the grants into grants from the government organizations, grants from CSR, and then other specific grants, and then there is a general others. Others, mostly we will report general donation, and there is a separate need to report corpus donations also. Now the net, other than that, normally the most of the organizations which I have come across will have an interest income. Why? Because as I told you, this corpus donation money, or somebody gives money, instead of keeping it the whole money in a savings account or current account which has very little rate of return, the organizations tend to keep it in a fixed deposit with bank, specified deposits, allowable deposits, and they earn interest income. Even the donor, the grant, the example project grant, people also will insist that if you have the money, the project happens over a period of say 6 months, and if you have the money in bank account, you can make a deposit of the money, and the interest also can be plowed back to the project. So interest income is another category. And the basic mandate under the Income Tax Act for these organizations for getting approval is, out of the total receipts, when I say, though the word used is income, basically it is the receipts. Out of the total receipts or income receivable, where they are very sure that money will come, they are supposed to spend 85% of the money which comes to them. This is the mandate. And if they are in the year of receipt, and or in the year in which they are expecting to get the money, very rarely you will have that receivable situations. As I told you, though it is the organizations are allowed to see, for example, under Companies Act, if it is a Section 8 company, they have to follow accrual base of accounting, but the computation we have to be very careful. If you see the way the computation is designed, it is based on receipts and payments account, because they say that even if you have a receivable situation, the application, this 85% utilization, they will not allow on payables. That is a specific amendment they have brought in under Section 11(7), where they say that only the money which has actually been utilized for the activity alone will be considered as application. Any payables will not be allowed as application. Only on actual payment it is allowed as application, irrespective of the method of accounting employed by the organization. So if it is a trust or society, has an option to follow cash base of accounting. But as far as company is concerned, since they are governed by Companies Act, accrual base of accounting is mandatory. They have to account on accrual basis, but computation, when they do, they have to be careful that the application of 85% computation has to be considered only on actual money which has been utilized, not on payables. Payables cannot be considered. In fact, there is a specific question in the form that whether there is any money which is payable. Allowed to accumulate 15% of the income from property held under a trust. So this 15% is like keep it for rainy days, like keep it for institution building. If somebody is giving you 100 rupees, if you spend the whole 100 rupees, Tomorrow, if nobody gives money, the organization should be in existence. It needs a minimum establishment of, it needs at least one person to run the organization. It has to have at least money to meet its statutory commitments. So keep 15% out of the money what somebody gives you, out of the whatever earnings, whatever income you get, out of the receipts what you get. Keep 15%. 85% is what they insist on utilization. Now, if there are provisions where they say if it is not possible to spend 85%, there could be a situation where the money had come and there is artificial cutoff of March 31st in a financial year. The major money has come, say in the month of March, which usually happens, which practically happens, because especially nowadays we see the CSR money. There is a requirement for the companies to give the money as CSR grants, and the money comes. Most of the organizations get a lot of money in the month of March. Now they will not be able to spend it within March or before the close of the financial year. So there could be a situation where the year of receipt they are not able to spend 85%. In that case, there is an option to accumulate the money, or rather the word is accumulation itself, but for want of our discussion and not getting confused, I use the expression the money to be spent. 85% is what they have to spend, they have to utilize. If there is an underutilization, or if they are not able to spend 85%, there is an option for the organization to file the respective forms with the commitment, either form 9A, where the money has already been spent, they are expecting to spend within the next financial year. There is a form 9A option where it is considered as deemed application, where the option is exercised by the assessee committing that the money will be spent within the 1 year from the date of receipt. Or there is an option to file form 10, where the money which has been received is for a specific purpose, and the particular activity or the particular project or the particular work will happen over a period of next 3 years. Means the form 10 can be filed committing the specific purpose for which the money will be utilized. It is very important. You can't mention general purpose. Nowadays, the income tax officer, during the course of scrutiny, they are asking that what is a precise project or precise purpose for which this money is getting accumulated. I mean, to be spent. That form 10 has to be filed within the due dates. Now, application of income is this one I already have told you. This is an amendment which they have brought in. So irrespective of the method of accounting, they have to follow this. So with this context in mind, these are the important sections to understand which are the relevant sections. There are basically 4 categories of sections under which the returns gets filed. The first category is charitable organizations, as I told you, trust society or section 25 company or section 8 company. Political party is also under 139(4)(b). This political party also, this ITR 7 will come. 139(4)(c), research organizations, who specific organizations who has got approval as research association or university or education institution, they have the compliance under section 139(4)(c), and 139(4)(d) is for the specific university or college who has approval under section 35. The rule is 12(7), ITR 7, income tax. This is the purpose, and the due date is depending upon whether there is an audit case or not. If the gross receipt of the organization is within the basic exemption limit before giving the exemption under section 11 or 12, the due date for filing the return is 31st July. Otherwise, it is audit case. The due date for filing the audit report is 30th September, and the report, I mean the IT return has to be filed by 31st October. And the other relevant sections for approval and application for approval are these sections with the relevant rules and forms I have put here for your understanding. In this context, I want to tell a very small point. See, the ITR 7, as far as the income tax rule 12 talks about the various ITRs which has to be filed for different categories of assessees. So this ITR 7 is exclusively for only the organization having approval under section 11 or section 12 or section 10, 23C and all those sections. So here in this context, we have to understand, if you have a trust, you have registered a trust with the intention to do a charitable activity, you have made an application to the income tax officer for getting an approval. March is over, the application is pending for approval. So you have to file the tax return. Now, pending approval, what you will do, which form you have to file? The form is, ideally I would like an interactive session, but since we have to cover a lot of topics, I will just keep talking and going. So the form part has to be filed in the case of this example where the trust has not got the approval under section 12AB has to file a return ITR 5 because it is still an association of person. A trust or a society is an association of persons, so they have to file a return under ITR 5 if the approval is pending as on the date of due date for filing the return of income. Now, if the approval comes within the before the timeline to revise the return, that is 9 months from the end of the financial year, from the end of the year, before the December, if the approval comes under section 12AB, then the organization can revise the return. The organization, the trust has to revise the return and file a return under ITR 7. So unregistered, I call unregistered means those organizations, charitable organizations which has no approval under section 12AB, they have to file ITR 5 in the case they are trust or society. If it is a company, a section 8 company or a section 25 company, subject to approval, they have to file ITR 6, the normal company return. Going forward. Now, next, understanding this context, let us understand some of the critical and relevant. There are a lot of amendments, but these are major and critical amendments to appreciate the reporting requirement. As I told you, if we can understand why a reporting requirement is there, we can understand it better if we know this is the reason for it because there was an amendment in support of that reporting requirement. So, as far as corpus donations are concerned, as I told you, corpus donations doesn't have, so the corpus donations are those donations which comes with the mandate to form part of the corpus of the trust or the charitable organization, and the 85% mandate to utilize the donation is not applicable for corpus donations. Under section 11(1)(d) there is a specific exemption where they say that the mandate to spend 85% is not applicable because the basic idea is, as I told you, corpus as it is not being utilized, only the earnings will be utilized. So now, since there is an exemption, since there is a benefit of that relief from the mandate, obviously the income tax statute want to make sure that the money is being utilized for the purpose for which it is given and it is properly invested and all those. People are not utilizing it for a wrong purpose. So with effect from this major amendment, assessment year 22-23, it was in fact relevant in the last year. Those who have filed the ITR 7 in the last year will know that last year ITR 7 was brought in with a very detailed table tracking the corpus donations, and we were expected to reconcile the corpus donation in the balance sheet under the investments with the respective deposits in the bank or the allowable mode. Under section 11(5), under section 11(5) of the Income Tax Act, they prescribe the specific modes in which the money of the charitable organizations can be deposited. So first amendment last year was, the major amendment was, if at any point of time, the charitable organization had a situation where they didn't have enough money in the form of general donation or other receipts to meet their basic requirement to carry out their activities. Especially many organizations faced this situation during COVID times where there was no money from the donor and they still had to run the organizations with minimum staff requirement and also statutory requirements. So they had a situation where they had to break the corpus. So they approached the corpus donors and they wrote letters and they got approval. See, the thing is, as I told you, the donor would have given a mandate that it shall form part of the corpus of the trust or the charitable organization. The organization unilaterally cannot consider it as non-corpus. They have to seek a specific approval from the donor saying that, look, you have given it as a corpus and because of we have a necessity, now will you please give us permission to convert the corpus into a non-corpus. So you need to get a specific approval, and once you get the approval, the organization will use that money to carry out the to run the organization or to run any critical project. Now, in that context, they brought in this amendment. If you remember, as I told you, when we do the computation of a charitable organization, out of the gross receipts, let us assume the organization had a gross receipt of 100 rupees, and out of that 10 rupees was corpus donation. Then the organization, when they do a computation, gross receipt 100 rupees, plus exempt under section 11(1)(d) 10 rupees corpus donation, and on the balance 90 rupees, only there is a mandate to spend 85%. So, since at the point of receipt of this original corpus donation, they would have enjoyed an exemption. Income Tax Act has told that if at any point of time you have a situation where you have to utilize the corpus for your running the organization or for any project, you can consider it as an application. Though you have spent the money, you can consider it as an application only in the year in which you put the money back to corpus. This is one of the amendments. So this is basically to make sure that the organization doesn't deploy the corpus and doesn't misuse the corpus, and make sure that the organization has a corpus. So though the money has been utilized, see what would have happened? They broke the corpus, and the corpus would have come as the money would have they would have had that money to utilize. The expenditure would have happened, right? So they can't claim it as an application to meet their 85% criteria. In the year in which they have utilized the corpus, they have to put the money back. Now, similar, that is one amendment, and also uh, put it back when they meant put it back, they have to put the money back to the specified mode of investments, which is prescribed under section 11(5). They have specific modes, predominantly bank deposits and government securities, where the idea that mostly they are risk-free returns, because the idea is to not maximize profit. As I told you, the basic premise under which these organizations work is not to maximize the profit. So the prescribed modes of investments are also with that idea in mind, not to make sure that you are here to sustain and survive, not to make profit. So if you see the modes also, they can't put it in a capital, highly volatile market or highly risky investments. Same rule, the same rule, if at any point of time, since we have understood the rule for corpus donations, same rule they have brought in, same amendment they brought in the situation where the organization has taken any loan and they have utilized it for running the organization. So there could be situations where there was no money, and one of they had a situation where they have to borrow money and run the organizations. In that case also, in the year in which the loan is repaid, only in that year, out of the income of that year, the loan would have got repaid. Only in that year, the actual utilization of loan can be considered as application in the computation. So here you have to be careful. What would have happened? You would have taken a loan in, say, financial year 21-22, or rather 22-23. Let's say this financial year you would have taken a loan and you have utilized the money to pay salaries and run the organization. Now, say you paid salaries of, say, 5 lakh rupees, and this 5 lakhs cannot be considered as application when you do a specific computation. Then what happens? Next year you got general donations and your other sources of revenue increased. The organization's revenue increased, and the loan was they were able to repay the loan. Then this 5 lakh rupees, which was utilized, which was actually spent in the financial year 22-23, will find a place as application only in the computation for financial year 23-24. So definitely there could be a mismatch between your financial statements and the computation of income. This is one very, very critical point which we have to bear in mind when we do the computation for these organizations. Unlike a for-profit organization of where we start the computation with profit as per profit and loss account, and any any allowances or any disallowances will always find place with your profit and loss account, right, or your income and expenditure account. But here there could be situations. These are some special situations where there could be a mismatch between your expenditure as per, depending upon your method of accounting, whether you are following accrual method or whether you are following cash basis. There could be a mismatch between your actual expenditure in your income and expenditure account, or rather receipts and payments account, and your computation. Okay, so that is the relevance of this amendment. Now, going forward, another important amendment is these organizations, as I told you, they have specific mandates. So in case of violations, if there were some violations, then they have the Income Tax Act has brought in a section saying that those categories of receipts or income which were not complied with the specific provisions, or where there were specific violations, that category of income or that portion of the income or receipt of the organization will be subjected to tax. So it was effected. It is an amendment where they defined what is the specified income which will be subjected to tax at higher rate of maximum marginal rate. They say income accumulated, explanation defines specified income. So the section says that where the total income of any trust or institution includes any income by way of a specified income, notwithstanding anything. So this is a non-obstante clause where they say irrespective of whatever there is in the other portions, this income will be subjected to a tax of maximum marginal rate, and the balance will be subjected to tax at normal portions if there is a tax. If there is no tax, no tax. No deduction. And another thing, because this is a penal provision, right? I mean, this they want to make sure that no organization should end up having this. No deduction in respect of any expenditure or allowance or set off of any loss shall be allowed to the assessee under any provisions of the act in computing the specified income. So their expression is specified income, and what is specified income has been precisely defined. Income accumulated or set apart in excess of 15% of the income, where such accumulation is not allowed under any provisions of the act. So this is one of the mandate, as I told you. They can, out of the receipt, they can accumulate or set apart, not for application. That is what that accumulation is. 15% only they can keep for themselves, right? 85% they have to spend. Suppose some organization has kept more than 15%, then that excess, that becomes a specified income. Then violation of accumulation with reference section 9A and section 10. This sections, sorry, form 9A and form 10. So under 11.1 explanation 1 subclause 2, there is an option. As I told you, there is an option to file form 9A where the organization is expecting that as on 31st March the money could not be utilized. They couldn't meet 85% criteria, but they are in a position that they will utilize within the 1 year from the date of receipt. Form 9A is a form which has to be filed. Or in case they are keeping it for more than 1 year, then a maximum 5 years, form 10. So if there is any violation with respect to filing of these forms, then that particular income becomes specified income. Then any investment in impermissible modes. Another very, very critical thing, as I told you, this beneficiary, the organizations, the benefits should be general public. If any of the specified persons associated with the organization, like a trustee or author of the trust or director of the organization, they get any benefit which in the opinion of the income tax officer is unreasonable. It is not justified. See, it is not that they cannot take salaries or they cannot take consultancy, but it should not be unreasonable. It should be justifiable. That is why there is a special reporting in this regard. This is very critical. Any payment made to specified persons under section 13 or section 12.2, the people who are beneficiaries, there is a specific reporting in our form 10B, this audit report. Last audit report, I mean previous audit reports also, there was a reporting requirement where we were expected to mention what is the nature of the money which is paid. Is it a consultancy or rent paid to a person who is a, say, trustee of the organization, and the trustee owns a property and the trust is being run in that property, and the trust pays rent to the trustee. Such receipts in the hands of specified persons we were expected to report in form 10B. Now that reporting has become more detailed in the present form 10B report. There is a separate table with more detailed information. So if in the opinion of the income tax officer, if they feel it is unreasonable or somebody has taken undue benefit from the organization, it is a violation. So there could be tax implications. Then income applied outside India, very critical. One of the basic conditions for the organizations to get approval under section 12AB is that the money should be utilized for the activities conducted in India. See, there could be situation where the people may travel to outside India for carrying out this activity in India. The actual project happens in India, but for one portion of for carrying out a portion, not even carrying out, for attending a conference or for getting some inputs or for a meeting in connection with the execution of the project, people might travel. There could be foreign travel, but the actual activity, make sure that happens in India, because this is an important mandate. Another very critical amendment as far as the organizations is concerned, they brought in a definition of books of accounts. So far they had not brought in, or they had not specified what are the books of accounts to be maintained by these organizations. Now they brought in an amendment in August 2022 where they told that these are the precise set of books of accounts and documents has to be maintained. It's a very detailed list. I didn't want to put it in the slide. So please refer to this new rule 7AA. After rule 7A, it is a very detailed list. Please make sure that this properly, the organizations for which we are the auditors or consultants, you advise them properly that these documentations are maintained properly, because if they are not maintained properly, we are expected to it will have a serious implication, because it will be considered uh, as a violation, and there could be tax implications. Audit report, this is another amendment which we are going to see now. Very important amendment they brought in. See, till last year, for all the organizations who has approval under section 12AB, the report, there was a form 10B report, and 10BB report was also there, but the amendment what they have brought in here is they have now linked it with the gross receipts. So if the total income of the organization, total income of the organization, or rather total receipts of the organization, without giving effect of the exemption, if it exceeds 5 crores, one condition, or if they have approval under FCRA and they get a contribution from foreign source, or if they have income from outside India during the previous year, then you have to give audit report under form 10B. In all other cases, we have to give report under form 10BB. This is very important. This is applicable for this assessment year. So this audit report, that is why this is a part of our session we are going to discuss. Other important amendments regarding the due date for filing Form 9A and Form 10. Earlier it was to be filed along with the return. Now they have told that this Form 9A or Form 10 has to be filed 2 months before the due date of filing return under Section 139. There was a clarification, like there was this circular number 6 of 2023 is an important circular. It is recommended to go through that circular, because many things they clarified in that. One of the clarifications was regarding this, because there was a request from the people that 2 months from the due date will become too early, because the audit wouldn't have happened and the numbers wouldn't have got finalized. It is too early to identify, or rather compute the amount that has to be committed in Form 9A or Form 10. So they have clarified that even if it is not filed within before 2 months from the due date, they won't deny the exemption, provided it is filed on or before the due date for filing the return of income, is what they have clarified. Maybe this being the first year of this amendment, they might give some lenient approach, but I think going forward, we don't know. Maybe they might take a strict view, but this is a clarification as of now. Now, this is the basic structure of ITR 7. We are getting into the ITR 7. This has last year's ITR had 23 schedules. It has two parts. As even last year also there was major part A and part B. That is the major bifurcation, and it had 23 schedules in the last year. This time, some schedules they have removed, and some schedules they have made it more elaborate. So it has roughly 30 schedules, and this is like I have just copied the heading from that ITR for you to easily digest that ITR 7. I recommend all of you please print an ITR 7 notified form from the website, and it is not at all a bad idea to print ITR 7 for assessment year 22-23, last year's and current year assessment year, and do a comparison. So in this, going forward in the next slides, what I have tried to do is, wherever there were major changes in the tables or in the reporting requirements, I have just mentioned that summary, or that specific column reference where there is a change in the table. Of course, full detailed discussion I may not be able to do for want of time, but I'm sure that as professionals we will be able to appreciate this form. With this minimum inputs we can start doing it. I can't say that we can fully understand with my session. I have tried, but definitely you need to go back to your workplace and print these two forms, and I didn't understand, because some of the changes you can, as I told you, you can understand why they have made, because there is an amendment. Some changes no, I'm not able to make out why they made. Maybe they will have some reason, or there will be some requirement which we are not specifically understanding. So this is part A general. Here in the last year, if you see, last year was the in the ITR 7, we had a requirement to submit our forms to get our 12A registrations renewed. There was a need to file Form 10A, 10AC and all, and some of the organizations got provisional registration, some organizations got permanent approval. So there was two categories of situations. So that is why in the last ITR assessment year 22-23, there was a reporting requirement for provisional registration also, but in this, all references for provisional they have removed, and they are saying that the final approval, I mean the provisional, if you have got a provisional registration, if you have got a final registration, there is no need to mention the details of provisional registration. Then here there is a removal of 153, option of 153A has been removed, because 153 up to 31st March 21 it was there, so that was a natural removal. And next is this is a new sentence they have brought in: whether liable to tax at a maximum marginal rate under section 64. So the earlier question was if disallowed under section 13(1)(c) or 13(1)(d), where there is a violation. 13(1)(d) is the benefit to specified party. Now that has been removed, and there is a new question: whether provisions of 1023C, provisions that 22nd proviso to 1023C or 1310 are applicable. So under section 1310, there are specific situations where there is a violation and there will be a tax implication. So whether that provision have you attracted? That's all they are asking here. They are asking question: have you attracted the provisions of section 1310? And if yes, then you have to tick yes to this question. So 1310 basically what it talks about is, see, little bit I have to tell here. Section 2 subsection 15, as I told you, there is a general clause called any object of general public utility. Now, if the organization is carrying out any activity under the precise limbs or specific limbs of charitable purpose definition, like preservation of environment or medical relief or education, then there is no restriction for them to get a commercial receipt. See, predominantly they will have voluntary contribution, but some minimum consultancy or some service they are doing or some training. Usually these organizations will conduct outreach programs where they conduct training to general public to educate them as to, say, reduce the use of plastic, or how to conserve water, or even sanitation or health or any matter of public interest. They conduct training programs and they conduct workshops, and they might collect a small amount of fee as a participation fee, only for the reason that the people who come to should be serious people. A minimum fee they'll collect. Now, these organizations who have approval under section 2 subsection 15 precise limbs, this is there is no specific treatment for that. But those organizations who are enjoying the exemption under 2 subsection 15, any object of general public utility, there is a proviso to section 2 subsection 15 which they say, unless the total gross receipt is within 20% of the gross receipts, the total receipt out of this commercial activity or the activities having quid pro quo nature, it should be within 20% of the gross receipts of the organization, and they have to maintain separate set of books of accounts. Then no problem, the regular computation they will enjoy tax exemption. But if it exceeds 20%, then what happens? They are telling that they are not charitable organization, they are here to make profit. That is the premise what the income tax income tax authorities will take, and in that case it attracts the first proviso while it exceeds 20%. In that case, section 13(8), section 13 is the section which talks about instances where section 11 will not apply. So that section 13 is a very important section to understand the situations in which the organizations will not enjoy section 11 exemption. In that, one of the subclause 8 talks about this organization having approval under any object of general public utility and exceeding the receipts of 20%, and section 11 is not applying. In that case, section 13 says that if any of the organization has income which is in the nature which falls under section 13(8), then 1310 invokes. So maximum that income will be subjected to maximum margin rate. So you can read section 1310 There it draws reference to section 13.8 and section 12.2, where there is a violation, where the books have not been maintained, or where the audit has not been conducted, where the organization was subjected to, it was mandatory for them to file audit report, or get the accounts audited and file the audit report. They have not done, or they have not filed the returns within the due date. All those situations, this 13.10 will attract. Whether the organization had any such situations, that is the question. This is a new question. Then another change is the new ITR 7 the details of particulars regarding the author, founder, trustee, and at any time. So this is one thing. Earlier it was as on 31st March. But now it is saying at any time during the previous year. This is little difficult. Like somebody is not a trustee, then we have to start working now. Their PAN number, all those details we may have to collect. And incidentally, this whatever details of this author, founder, trustee, and manager is coming in our audit report also. So and we are signing audit report true and correct. So it becomes our responsibility to make sure that, earlier it was a part of the income tax return. So that sometimes what happens, we are not able to get somebody's address in the last minute, and they'll tell that please put organization's address and file the return. It was acceptable because we are not certifying it. But now they have brought in these information also as a part of the audit report. So make sure that we start the homework early and we have the correct data. Then another change in Schedule I. This is the table I know it is not readable, but at least you will be able to go back to the ITR 7. So but I am details of amounts accumulated or set apart within the meaning of section 11.2. So what is 11.2? 11.2 is the section which talks about the situation where the money will be is expected to spend over a period of next 3 years. Up to maximum 5 years, they can keep the money. So Form 10 has to be filed. Say if so, in this, compared to the earlier table in the last year's ITR 7, they have brought in another 2 new table saying that amount taxed in earlier years. So did you have a situation where did the organization had a situation where the money was accumulated to be spent within 5 years? Now they were not able to spend it within the timeline. And what happened? Because they were not able to spend, that money became taxable income, and the organization had to pay tax. So whether there is any such situation, that also they are considering it as one of the deductions. This was not there in last year ITR 7. Now, in this context, I want to tell, I'm addressing section 11 and section 12A, B, and DT. So, in the last financial year, they made an amendment. Most of the provisions which are applicable to section 11 entities are applicable to the entities which has got approval under section 1023, C21 and all. So, that's why, or they have put in almost all the cases, you will find that they are treated at par as far as the compliance is concerned. Now, here what happens, 115 BBI specified income. So if there is any taxed income, I think I expect that we will be using either the income tax utility or Winman or any software. When some of the tables are filled in, some of the things will be auto-populated. So this will get reflected in a schedule. There is a schedule for reporting the income under 115 BBI. So when the number gets reported here, it gets reported in there also. Then this is a new table where they have brought in details of, so here they are asking amount if any was subjected to tax, and then next table is details of accumulated income which was subjected to tax earlier year. So if at all there is anything, we have to report here. Same way, next amendment is in again deemed application, that is Form 9 case, where under explanation 1 to 11.1, where Form 9A was filed saying that this will be applied. It is considered as deemed application, where within 1 year from the date of receipt it is applied. Here also they have included, this table was there in the last ITR, but two new columns they have included saying out of the deemed application claimed amount required to be applied. This is a new thing. So you have deemed that I will apply 1 lakh, but out of that really how much got applied? They are asking again precise question. And again, out of this, in these situations, did the organization had any situation where it paid tax, right? correspondingly, for the amount which is subject to tax, they have brought in a table saying any of the deemed accumulated income was subjected to tax, then we have to give the details here. Then next statement showing the funds and investments as on, this is Schedule J. Schedule J is the schedule which talks about the details of investments made by the entity. So this is the comparison. So compared to old ITR, here they say assessees claiming exemption. So in the old ITR, it was mentioned as if they are registered under 12A, 12A, 12AB or approved under all these 1023 and all those sections. Now the wording is like it has to be filled by assessees claiming exemption. So they have linked it with claiming the exemption, not approval under the respective sections. And in the last ITR, details of corpus table we filled here. However, in the new ITR, this table has to be filled only by the trust who are claiming exemption. So we, in your case, you have to find out whether they are claiming exemption, then only this is relevant. Now, Schedule J of the new ITR, new columns has been added. Here, new two. See, whatever I have marked in yellow color are the two new columns compared to last year's ITR. Now, new column is like, again, amount tax. In all these places, they have brought in that because of the amendment of 115 BBI, wherever there was a tax implication, they are asking us to report. So most of the cases, you may have a zero there because they may not have subjected to tax, but that they have brought in. And total amount invested or deposited back to corpus. So this is why this column is, because that is because of that amendment where they told that unless the corpus money is deposited back, you cannot claim it as application. So now they want to track it here whether the money is deposited back, and to that extent only application can be claimed by the organizations. That is why this new table is introduced. Now other relevant changes is as far as the corpus donation is concerned, the way of reporting is like whether you have received, whether the organization has received any corpus donation for the repair, renovation of the religiously important places like Gurudwara, temple, mosque, etc. Under section 80G2B, those categories of donations, whether they have received any corpus donation specifically for this purpose, that has to be reported separately. Then, other than the above, any corpus donation received after 1st April 21, they are asking us to report, because the amendment of that, if any corpus has been utilized, it has to be plowed back, came in Finance Act 21, Assessment Year 22. That is why Finance Act 21 brought in that amendment. So that 1421 is relevant. Before that, it was not there. Like there was no requirement. Then other than, so these are the three categories in which corpus donation has to be reported. And so this is the table where it comes. So this is the amendment. This is the table how the Schedule J comes compared to last year. Corpus not applied. So opening balance from the last year ITR, you will take the opening balance of corpus which is not applied till year. Then during the year any application has happened. If you have applied anything plowed back, last year you applied and put it back, all those reporting has to come here. And the closing balance of corpus fund has to match. And what have you done with that corpus fund? Have you invested in the specified modes? Any taxation, everywhere that column is included. Last time also we had a reporting requirement where we had to reconcile the corpus donation with investment. So that remains. These are the changes. Then other thing is the change in the columns. In the old ITR, the loans and borrowings were, they asked us to invest, like somebody has taken a loan, and if they have invested, they are asking, invested in the mode specified under section 11(5) as on 31st March 22. They ask, but now the need is like, if you take a loan and if the organization takes a loan and if the utilized for application, then the money has to be repaid. There is no need to invest. I mean, the money has to be repaid to consider it as an application. No requirement to deposit or invest in specified mode. So these two columns have been removed. Instead, this is the way it is. Total repayment has got substituted. So this is because of that amendment. Now, as far as Schedule JB is concerned, only corpus investments and deposit as on 31st March 23 is to be provided. Last year, all the investments we had to bring in and we had a tough time reconciling. Here they say details of corpus. So from your balance sheet and books of accounts and balance sheet of the entity, you should be able to identify the investments which are specifically relating to corpus. So this is the old ITR and new ITR. You can appreciate the difference. So this is how it is. Now going forward, screenshot of the new requirement. So these three classifications, whatever classifications I told you in the beginning, the corpus for the renovation, then corpus received on or before after 1/4/2021, and other than that, these are the three categories. So this information, how far the assessee has kept this information, see the tally will have one number or the books of accounts will have one number. Now you may have to take this information, make sure that we have enough data for reporting in the ITR 7. Now, in Schedule J, investments held at any time during the previous year, persons referred to in 20. So, as I told you earlier, some of the provisions which are applicable to the entities registered under Section 11, Section 12 was not applicable for the entities under Section 10, 23C and all. Now, since it is applied in mutatis mutandis, they made that amendment. They have included that section also. So investments held at any time during the previous year in the concern in which the person referred to in section 13.3, and so this is because of the amendment where the new regime was brought in and it is applicable mutatis mutandis to the organizations who has approval under section 1023C and relevant sections. That is why they have brought in this amendment. Whether the organization, so section 13.3 has a list of people, and if the organization has invested any money in any of the organization having where these people have substantial interest. So that is the question here. Now coming to balance sheet, these are some of the changes which I have observed. The investments in the old ITR were required to be bifurcated whether invested or not, whereas in the new ITR, no need of that bifurcation. However, there is a new column where total application of funds. So here in the new ITR balance sheet, and I'll show you that. The thing is, now the organization, this is a new requirement, okay? Now the organization has spent the money out of the total receipts. The organization has applied money. Last ITR, till last ITR, we will reporting the total application, how much is out of the current receipts, how much is out of accumulation, all those things, so on and so forth. Now this time they have, in addition to the source from which it is being spent, whether it is out of current year receipts or is it out of accumulation or is it out of the 15%, whatever the organization has set aside. In addition to that, there is a requirement to bifurcate between revenue, capital, and also electronic mode and other than electronic mode. That comes in the audit report. So this is a new requirement where you have to really identify the source, and that reporting comes as a part of the reporting in the financial statements forming part, I mean, the ITR actually. Bifurcation is asking into the total application of funds into the respective modes, how the money has been spent. I'll show you that ITR 7 if time permits. But it is very clear. If you open the ITR 7, you can make out. Another major change in ITR 7 is Schedule R, where there is a reconciliation of corpus as per Schedule J and the balance sheet. This is again corpus out of the donations received for that renovation, then 1/4/2021, and also corpus other than that. This reconciliation is very important. And I think I expect that in the auto population thing, when we key in one table, I think the numbers will flow here. Then another schedule ER. Amount, this is what I was telling. Amount applied to the stated objects of the trust or institution during the previous year from all the sources, either out of revenue account or capital account, is what we had reported in the earlier ITR. But now a new schedule A has been introduced where it is reproduced like this. So if you see the left hand side, there is a details of the application. To the first portion, if you can see, it is for that specified purpose. Let me see if I can. Yeah, I hope this is visible. So this is the requirement. This is very critical, where each act. So earlier this was not required for, if you remember, out of the total, whether it is revenue expenditure, capital expenditure, the way of reporting is different, and source, out of which source it is being spent, they are asking. Income, is it from the accumulation, or is it from 15%, or is it out of corpus fund, is it out of borrowed fund, or any others? These are all very critical, because if you are saying that your utilization is out of corpus fund, then that cannot be considered as application. It will be automatically, if you see here, the formula here, I hope it is visible to the people. If you see here, the total amount applied during the year is A12 minus, all these items are going to be minused, right? So A12 minus B minus C2, C3, then C4, C5, C6, 7. From where you have spent, then finally they'll consider as application. And so this is a major amendment for which we have to be careful. Next is income and expenditure account. Here I and E. If you see schedule IE, there are 4. Schedule IE 1, 2, 3, 4. Like that they have brought in the schedule IE 1, schedule IE 2, schedule IE 3, and schedule IE 4 with the relevant section. So you have to be very, very careful here. Income and expenditure account applicable for the assessees under the specific sections. So then some sections come here, some sections come in IE2, some sections come in. So you have to see which is applicable for the assessee, and accordingly the relevant table has to be filled up. Now, next is house property income. There is a new field where they have mentioned specifying the name of the country, and that is one small amendment in schedule for house property. Then schedule C capital gains. Here, because of 115 BBH, we have virtual digital asset. There is a table, new schedule introduced. And so this is the table for virtual digital asset. Then these are all small changes. When it is relevant, you can see special rates has been introduced. Then accredited income. This was there in the last year return also, but small changes they have made. When the institution has any situation and tax comes, then this is the important amendment, 115 BPI new section. So here this 30% category income will be reported. Then in the schedule for fixed assets, they have made a small change. Relevant calendar year is removed as during the calendar year. The relevant word is removed. And now finally, whatever changes, whatever keyed in happened in various, see when you, this auto population, accordingly the corresponding impact will get reflected. So if you open that return and see, you can see that it flows, and accordingly the statement of computation will change. Then part B3 here, this is specifically for 115 BBI amendment, where this 1310 is a violation. This I have already discussed. Specific questions are there. See the question and answer relevant. This is the table for reporting that. This is a big table. So I just wanted to apprise you that this much is there. So make sure you start your work early. So this is as far as ITR 7 is concerned. Now, coming back to Form 10B, I don't have a separate slide for Form 10B. I will see the just maybe I will take those questions. Yeah, so let me answer the question. Is the first question from Raj Kishore? Is that the first question? Whether income can be shown on cash basis to match the utilization on payment basis. Yeah, actually that is the correct way of reporting, because if it is receivable, as in form 9 is the form only where they have envisaged a situation where you have not received the money. Now here you have to take a stance on what basis you are making the computation of income. From my experience in scrutinies earlier, one of the income tax officer only has guided us, saying that as far as the charitable organizations are concerned, the mandate is to spend the money. So if you consider the income on accrual basis, when they are saying that the application has to be considered only on payment basis, you will end up having a situation of accumulation and committing to the department that you will spend some money where the money has not yet come. So in my opinion, the computation should be strictly based on receipts and payments, the actual outflow and actual inflow, where you can, because section 11 is a fiction, right? It's a deeming fiction where they have put a percentage of 85%. So if you are showing the receipt on accrual basis and they have made an amendment that only application is all only on payment basis, then you will have a to be spent situation and you will end up committing to them saying that we will spend it where the money has actually not come. So that is my view. For 15% unspent amount also need to file any form? No, there is no need to file any form. What about the receivables and payables of last year received and paid during the year? So when you say receivables and payables, in the books of accounts, you will follow according to method of accounting. Now, if there is a receivable of income, once it comes only when it hits your receipt and payment account, you will have a mandate to spend it. If it is a receivable, money has not come to bank account, you can't commit that you will spend it. Payables anyway you cannot consider as application. As I told you, books of accounts you will follow with the method of accounting, but in computation you cannot consider it as application. Are the amounts set aside based on 9A requires to be invested in the specified investment mode mentioned under section 11.5? There is no precise requirement. The thing is, in 9A the assumption is like you will spend within 1 year. But one of the modes of investment is bank account. So definitely that money is in bank account. So it is a specified mode only. Now, Form 9A filed since the filed the amount received on March, unable to apply due to less time. In fact, more precisely, the timeline within which we are utilizing. See, if you see that that explanation 1, there are 2 situations they have told. Option exercised because the money was not actually received or for any other reason. So I will tell you my one practical experience where we filed Form 9A from our office. Was a case where as on 31st March the money had come, but by the time we were filing the return in the month of June or July, they had to give the money back to, it was some funding from an international organization. Then the organization wanted a license to do that work. It was during the COVID period. They wanted a specific license to execute the project, but the organization were not able to get the license, so they had to give the money back to the donor. Now, as on the date of finalization, I am very sure that it is wrong to commit to the income tax officer that this money will be spent within the next 1 year or 2 years. So we, in that specific context, we filed Form 9A saying that the money has not been applied, and any other reason we mentioned the reason saying that the organization didn't get the license. Now, this is one situation. This is a practical situation I told you. Others, if you read the section as it is, they say that where money has been utilized within the next 1 year or within the next 1 year after the money has been received. That is what they say. So in the receivable situation and you are expecting the money will come within 1 year or 2 years, you have to be very sure that you will spend within the next year of the receipt. So to answer the previous question, when somebody is showing the receipt on income on accrual basis and expenditure on payment basis, Form 9A could be one solution where you say that we have a to be spent situation because the money has not come, and you are committing saying that. And now we have the table, right, where specifically they are asking. See, one amendment I told you, out of the deemed application, how much you were supposed to spend and how much has been spent. So out of the deemed application, you are expecting 1 lakh to come, you are expecting to spend within the 1 year from the year of receipt. Then accordingly, how much you have spent will automatically get reported in that table. If there is a violation of 13 second provision, there is a disallowance to be stated. Whether this is total income and expenditure. There is a disallowance to be stated. Whether this is total income and expenditure. Actually, it is like, how should it is total income and expenditure. It is not total income and expenditure. It is like, they will not allow you to consider it as an application. In fact, the benefit of section 11 will not be given for the specific value for which the violation has been committed. So obviously that amount will not form part of total income. See, if you read the beginning of section 11, what it says, saying that this particular income will not form part of your total income provided you comply with XYZ conditions. So the moment you are not complying with that conditions, it forms part of your total income. That whatever receipt, we will be subjected to tax. That is how you have to appreciate it. How should be the valuation of donation in kind to be carried out? If there is any specific provision, fair market value, no specific provision as far as I remember, but I can check on that and let you know if I have a different answer. To the best of my knowledge, it is fair market value. Some of the organizations I have seen in accounting policy, they commit, saying that if they receive any asset as donation in kind, it will be accounted at, it will be shown at cost or at a nominal value. In FCRA reporting, see, these charitable organizations, if they have an approval under section for approval under Foreign Contribution Regulation Act, in addition to the income tax return, they have to file a return FC4 under FCRA Act. Right? In that, there is a specific form to be filed when they receive donation, and there they ask fair market value. So, if you really see this case, it will not see if you make your computation based on receipt and payment account. It is a kind, right? So, it will not form part of your computation. Like you can't. There is no mandate to spend 85%. It is only a reporting of donation in kind. You can either adopt your accounting policy or you can account it as fair market value. As far as I remember, there is no specific guideline, but I will reconfirm that if I have a different answer. Books of accounts maintained to be disclosed. Maybe books are kept at locations other than registered office, whether each books of accounts should be entered for all addresses. So here, actually, there is clarification, like if you are maintaining at a office, you have to inform the other than registered office, you have to inform within 7 days to the jurisdictional assessing officer at the address and all. So you may have to comply with that requirement. 9A. Spend 9A. 9A can be filed. What is the treatment of permanent? What is the treatment of permanent fund where only income is used, like deposits in bank, interest is used for daily expense? This is the corpus fund. When you call permanent fund, I assume it is a corpus fund. So interest or whatever income earned is subjected to that 85% mandate. Can we please get this slide for future reference? Yeah, sure. Is then be required for gratuity trust. So gratuity trust, if they have section 11 approval, then yes. Form 10B applicability is governed by Rule 17. So you can refer whether that conditions under Rule 17 is applicable. That is the condition under which you decide whether 10B is applicable or not. To be filed for advance receipt from sale of land. So Form 9A, that is the answer. I mean, specific precise situations. Now sale of land. Now you received an advance received from sale of land. Now receipt, okay. What are you going to do? See, in fact, 9A is an option you are filing as to committing what you will about the expenditure actually, not about receipt. You received the money, but you are not able to spend. In that context, you are filing Form 9A. How should we do the valuation? Okay, can I come down? Whether renting a conference hall or a marriage hall by a religious institution considers commercial activity or business activity. So this it is the organization, I assume, is not under the precise under charitable purpose, under any objective general public utility, and if they have a marriage hall, if up to 20% of the gross receipt, and also what are they letting it out for, like for Is it incidental to their objects? See, if it is not incidental and if they are really running it like a commercial activity, Section 11 benefit will not be given for that stream of revenue. 33D, where the auditor has any income account set apart in excess of 15% of the income, as such accumulation is not allowed under the distribution of the which is chargeable to tax. Can you explain on this? Sorry. Where the auditee has any income accumulated or set apart in excess of 15%, correct? Is not allowed under any specific portion of the Act, which is chargeable to tax under Section 13, amount of such income. So here, if the assessee has received 100 rupees and if they have accumulated 25 to 30%, they have spent only 70%, then that 30% is a violation, right? So it will form part within the definition of 115 BPI. Form 10A be filed before 30th June, approval not received. Income tax department, but the notice was available in the IT portal, rejection order. Rejection order. However, the notice neither received, ITR 7. So, first of all, if you have not received approval, from the question, I assume that Section 12 approval has not come for the organization, you can't file ITR 7. You have to file ITR 5 till you get approval. If you don't get approval forever, no ITR 7. Once you get approval, you can revise the return if the timeline for revision has not got expired. In ITR 7, what schedule we have to show interest income, whether we have to show it as other sources. So in ITR 7, the interest income forming part of the objects of the trust, like as I told you, they invest the corpus money and that interest. If you see in ITR 7, there is a specific place to report the ITR interest, not under other sources. Because the income itself, the whole income gets reported under ITR 7. So under voluntary contributions, there is incidental commission, rent and all. There is a place to report it. There. I will show you after the session. It's not specifically in any other place. Whether admin expenses should be included, yes, of course you can include admin expenses, and there is a separate requirement to report admin expenses separately. Is there any threshold limit for utilization? As far as admin expenses are concerned under the Income Tax Act, so far there is no threshold. FCRA has brought in a threshold of 20%, but as I told you, here you have to apply the judgment. Imagine somebody has given donation of 100 rupees for the organization to carry on the objectives. The premise under which the organization got approval is to carry on the objectives of the organization, right? Now, if out of the receipt major money, if the officer opened the income tax return and it is seen that major money is spent on admin and not on project expenses, obviously there could be a question. There you have to apply your mind. Though there is no specific restriction as far as admin and actual activity is concerned, but definitely you have to be alert to the situation and you have to bring it to the attention of the client, look, saying that they have not been given income tax approval to carry on the admin activity. They have been given approval to carry on the charitable precise objectives. Can trust accumulated Section 8 has received a grant from central government, and the grant amount should be used to promote incubators like startup companies. However, to fulfill the grant amount, it will take me. Okay, so can we carry the remaining grant balance in the balance sheet? Yes. So in this context, I want to tell the revenue recognition. See, Accounting Standard 12 on government grants, there is a specific provision where the grant is recognized as income to the extent of obligation is discharged. So specific grant at the point of it is an obligation. I am talking about accounting. At the point of receipt, it is an obligation to be discharged. So debit current liability, credit current liability, and it is recognized as income to the extent of expenditure incurred. This is from accounting point of view. But as far as computation is concerned, when you are making the computation based on the receipt, what happens? Your 85% mandate will trigger in. Then you have to file a Form 10 or Form 9A depending upon the situation of the utilization. You may have to file a form for accumulation and commitment to spend in future. Yes, at the point of receipt, it is an obligation. Here, the computation, see, here is the answer. Like, are you making the computation based on your income and expenditure account or based on receipt and payment account? If it is income and expenditure account, you will recognize the grant to the extent of utilization in the income. and your expenditure is accounted on payment basis. That is also a method where there is no precise mandate as to whether you should make your computation based on income and expenditure account or receipt and payment account. Actually, there is no precise mandate. But from the amendment and also from the way the computation is worded, you have to spend. So unless you receive, how will you spend? That is the logic. And where there is an obligation to spend, obviously at the point of receipt, it is not accounted as an income, it is accounted as an obligation as far as balance sheet and income and expenditure is concerned. Whereas receipt and payment account, as I told you, you may have to commit for future expense. Government project received previous year same project amount in current financial asset. Respective project did not return asset belong to that project. Can I need to consider as income or liability in the provided your opinion? Not maybe I assume that question is like this. The grant came and one of the budget in the grant was to purchase a capital equipment, an asset, and the asset was purchased by the recipient organization. Now, as far as the computation is concerned, one of the expenditure for application is capital expenditure. So any asset is purchased whether out of the grant money or whether out of the own resources, it is considered as an application and is reported separately. That is why no depreciation also is not separately provided. Now, in the computation, in the year of purchase, it is considered as an application. Now, as far as accounting in the books of account is concerned, I have seen organizations accounting the assets which is purchased out of project money as separate project assets, and on which they don't compute in accounting policy. They say that we don't charge a depreciation because it is held in fiduciary capacity, because as per the grant there will be an obligation to return the asset, and after the project is executed and they get an approval from the donor that the asset form part of the organization, that time it is moved as own assets and they start claiming depreciation. This is for the entities which are not companies. As far as companies are concerned, they claim a depreciation, and what they do is, out of the total grant money received, this is another treatment. Out of the total grant money received, the portion which has been utilized for purchase of grant is considered as capital grant, and so the total grant money is bifurcated as capital grant and revenue grant. Say for example, 1 lakh rupees came, say 70,000 is towards revenue expenditure and 30,000 is towards purchase of asset. 70,000 is revenue grant, which is recognized as income at the point of expenditure, to the extent of expenditure. As far as 30,000 grant is concerned, it is considered as capital grant and parked under balance sheet, and it is recognized as income to the extent of depreciation. So if you see the profit and loss account, there will be depreciation equal number, the income and expenditure side. This is as far as balance sheet income and expenditure is concerned. As receipt and payment is concerned, at the point of receipt, it is a receipt less 15%, mandate 85%. Purchase of asset as it is considered application. So depreciation has no meaning. Can we get this PPT? Sure. Okay, now it is 6 o'clock. I'll come back to the questions. Let me start the audit report. But definitely, I assure you that these questions chat box can be shared to me, and if at all I'm not able to answer the question, we will somehow make sure that we give you the answer to the best of my knowledge. Let me go back to the session. Now we will form first and foremost, they want the auditor to be more responsible. They have made it like our Form 3CD reporting. Most of the things what is a part of ITR 7, including, as I told you, the details of trustees, members, all those things now is a part of Form 10B report. So we need to plan well, especially and given the fact that in this case, Form 10B will be relevant if one of the conditions are satisfied.
Hello.
Yes.
Madam, sorry to interrupt, but your screen is not visible. I guess you'll have to
Yes.
reshare your screen.
I'm sorry. I'm sorry. Now is it stop sharing?
No, it is not visible.
1 minute. 1 minute.
Maybe if you can stop the screen share and do it again.
Yeah. That's what I did. Share. Now is it now, Deepak?
It is not visible to me, but there are,
is it visible now?
There are people on the chat box who say it is visible. So I guess it is visible to others. Somehow I am not able to see it. Okay, madam. I think we are good to go. Please carry on, madam.
Can I try once again?
No, no, it is visible to others. So in the chat box, we are getting a lot of responses that it is visible. So
Okay, let me anyway try entire screen. Yeah. So Form 10B audit report, the relevant rule mandate definitely Rule 16CC and Rule 17B. Here, like a tax audit report, Form 3CA, 3CB, we are certifying true and correct. And also we are certifying the true and fair view of the financial statements. And unlike 3CA report or 3CA report where we draw attention to a CARO report date, in this case they have not given so. I mean audit report date under CARO, I mean the audit report under Companies Act. In the case of a Section 8 company, there could be an audit report under Companies Act, but there is no place to put that in this first page of the report. And here we go. If you see the left hand side, basic details, then registration details, these are all facts. There are no interpretation issues here. Management, the thing is, as I told you, make sure that you get the data because we are signing the data. So there could be situations where some of the trustees are non-residents, difficult to get their information. Then some of the there could be situation where we are reporting some data for which the person is no more in existence. All those complications you have to foresee here. And your intern has to be well instructed to make sure that the data collected is correct. It may not be a bad idea to discuss this portion with the senior management of the company, I mean the organization, to make sure that the data gets reported correctly. Because earlier we used to finish the reporting requirement, we send the data requirement to the accountant and he gives the data. So that may not be possible this time. Next is, as far as the objects is concerned, they are asking whether there was any modification in the object. So these are very critical questions. We cannot blindly go. We may have to ask whether there was any amendment in the trust deed or bylaws of the organization or any memorandum, sorry, any articles, memorandum objective clause, any changes there. Then those related questions they are asking. And whenever there is a modification of objectives, as per the approval mandate, they have to inform the principal commissioner whether they have done that. If not done, then you have to advise them properly that necessary actions have to be taken, because these are all forming part of the audit report. Whether application has been made, here they are asking about the approval, whether necessary approval application has been made and whether the approval has been received. Going forward, commencement of activities, this is relevant for those organizations who has commenced, you have a new entity, and the critical dates, whether the auditee has been granted provisional registration. They're all basically facts. There is no specific conceptual, difficulty here as far as I see. Then here, this is the question, I think one of the questions in the chat box, where details where books of accounts are maintained. So here nature of books drop down will come, whether maintained by the auditee, yes, maintained in the computer system. So here there could be situations where the full accounting department is outsourced by the entity. So it may not be a good idea to simply say that I have not maintained. Instead, what you can, some of the clients of ours are doing that, they set up a remote system within the organization so that they have access. So it is like books of account is maintained within the organizations. The work is happening somewhere else. That doesn't mean that the organization doesn't have books. So these are some of the ways people have found out, because we don't know whether maintained by the auditing. No, if you give, whether the officer will understand it as a situation where it is a, I mean, it could be it can be construed as a violation. Whether maintained in computer system, of course, yes. Then whether maintained at registered office, here, in my opinion, try to give an answer, make necessary arrangements to give an answer, yes, here. And you can say any other place also. But here the thing is, if you have maintained in any other place, then the mandate is like you should have informed the officer. If it is not done, at least now they can do, so that this question has come. You can see that I had told you that amendment regarding maintenance of books of accounts, there it is a very detailed explanation as to what are the requirements as far as maintenance of books of accounts are concerned. Please follow that. Then advancement of general public utility, this is the last limb. So if you see here, specific link based questions are very rare, because they are very sure that they are doing that precise activity. So there is no that proviso of section 2 subsection 15 is not applicable, where there is a mandate that the gross receipts from any commercial activity should not exceed 20% of the gross receipts. So here there is a question where in any of the projects or institutions run by the auditee, one of the charitable projects is advanced object of general public utility. Here you make sure that when they made an application for the renewal of 12A or 12A or whatever the 12AB approval, whether what are the specific links under section 2 subsection 15 which has got approved. There could be situation where the organization has got approved under one specific limb and also general public utility. Pay attention to this. And when they say project or institution run by the auditee, there could be a situation where your client is a charitable organization, a trust, and they conduct some program which a name called some Shakti or some specific projects. If you want, you can, I mean, that is what they're, or specific institution. Very unlikely there will be a specific institution unless it is a big group of institutions and they have specific institutions for each particular activity. So just pay attention to what is there for your client and answer these questions. So then they are asking whether any activities carried out is in the nature of trade or commerce under section 2 subsection 15. What is the percentage of the receipts? Whether that is in the course of carrying out the activity of general public utility, whether it is incidental to the main activity. See, even if they have a trade activity under general public utility, it should be incidental to the main objective of the organization. It cannot be completely different from the objective of the organization for which it has got the approval as a charitable organization, right? Suppose it is approved as a charitable organization, say empowering women or training for they are giving vocational training to one section of people. Like challenge some people who needs help, and they are making that giving them training to make some products, some handmade products, and this organization is helping to sell those products and get that money to these people. Means the money whatever comes out of selling of those items what is made, and that money is again utilized for the objectives of the organization. In that case, that business activity, though they are selling it for profit, it is incidental to the main activity of giving vocational training to the people, right? Suppose they start an altogether a different business which has nothing to do with their main objects, then it is a problem. It is their own income tax officer doesn't want that. Even if it is within the limit of 20% receipts, make sure that, so when they say that we have a business activity or we sell something, we get that money, accounting wise it will be perfect, it will come to the same bank account, even the money they would have utilized for the objects. But be alert, I mean make the client alert to the fact that, see, look, of course you are making money and you are within 20% receipts and you are using the money for objects, but is it incidental to your objectives? See, for example, vocational training organization, they can't run a catering unit and earn money and say that my total receipts from trade activity is less than 20% and the money what I get from running a catering business, I'm using for the objectives. No, that is not allowed. So it should be incidental for the attainment of the main object. So please go through that. See, these are all, of course, these questions were there as a part of the income tax return in the last year. But now since it has come in our audit report, the more responsibility is expected from the auditor. It may not be a bad idea to go back to the trust deeds or the original documents where we have long relationship with some clients, and we assume things are happening as we understand. There could be some changes in their activity with client unknowingly. They are doing, remembering this mandate of 20%. He would have forgotten everything. We would have told them that, we would have advised them that, see, make sure that from whatever business you are doing, your gross receipt is within 20% of the gross receipt, then you are fine. He will be remembering only that point. He would have forgotten for whatever reason that the nature of activity is different. So that is very critical, right? These are the things which you have to be careful when we practically do the situation. Then see, business incidental to the objects they are asking. And they are very precise. What is the business? What is the business code? Whether books of account has been maintained separately. Again, they are asking, see, whether the business is incidental to the attainment of the objects of the auditee. Now we are expected to give an answer here, yes or no. So we should know the answer. If it is not incidental, how will we answer no? I mean, we are expected to answer no. Now with that implication, what will happen to the organization? They might tell that, see, you are not complying with the mandate given, we will take away your 12A means problem. Then, so this is very critical. Another important amendment is, this is one new thing. See, what happens, the organizations will get grant money. Okay, somebody will give, in my example, I told you, somebody is giving a CSR grant or a specific grant telling that please study the level of pollution in the Bangalore lakes and please give us a report, do a survey, statistics and all those and so on and so forth. Now it is a grant. As far as the organization, the recipient organization is concerned, it is a voluntary grant with a specific purpose, which is in ally, which is their objectives also. They are into the their main activities in preservation and they are doing this, right? Now it is a grant. As far as the organization is concerned, it is a voluntary contribution with a mandate to spend 85%. Fine, fair enough. The organization which paid the money, they did a TDS under section 194C or 194J. So till this time, we used to take a stance or we used to advise the client, say, see, he did a TDS under that section for whatever reason. As far as recipient organization is concerned, it's a grant money and you have an income tax exemption, whatever TDS happened, you please seek a refund. Now, the thing is becoming more serious. Now, if somebody does a TDS, they want us to report in the audit report that receipt under which section TDS has happened. Now, first year is asking this, what is his aim in this? Now, more and more the organizations get TDS under 194J means they will tell that, see, you are not doing charitable activity, you are doing some activity which is in the nature of commercial receipt. That could be the intention of the legislature. So, make the client alert to this table and saying that at the time of negotiating or at the time of talking to the donor or at the time of writing proposals, they clearly communicate to the donor that they are a charitable organization, so on and so forth. What is the mandate and this reporting requirement, how it might affect badly their approval, all those things, that additional work the client has to interact with the donor. This education you may have to, you and me, we may have to do to the client is what I am foreseeing. But for this reporting, as of now, everything would have happened. We have to report it. So check your 26 AS, AIS reconciliations, everything, and make sure this is reported. Then here, again, see here I told you know that section 1310 violation question is coming. The same question we saw in ITR 7, whether the provisions of 1023C, 22nd provision and 1310 is applicable. The same question we saw in ITR 7. So they are not happy with only the answer in ITR 7. They want us to apply our mind and report here. Now next, this is this section is very important from 21 to 27. This full table is voluntary contributions. We have a lot of work here. Now we are all aware that the recipient organization has to file form 10BD reporting the donations details, and the due date was June 30th. May 31st was extended to June 30th. Now all of them would have filed. Now, what is our job here? They are expecting us to do a reconciliation of whatever they have reported in 10BD with the total voluntary contribution of the organization. So the organization would have received a total voluntary contribution of say 5 lakhs. Out of that, the organization would have reported only some 3 lakhs in 10BD. Okay, and another 2 lakhs was not reported for various reasons. One reason could be out of 2 lakhs to the extent of 50,000, they never got the full details, like name and address. They know it is not an anonymous donation, but they don't know the PAN number or some information for reporting in 10BD was not available. So for that reason, even if it was a donation to be reported in 10BD, they didn't report for want of availability of information. That is one category. Another category could be foreign contribution. Amount received from a foreign source. The foreign source, the details what is required under 10BD is not available, or there could be a situation. So they have not reported. Another situation was it was from government. The government money came from government, so not reported in 10BD because no ATG benefit or anything given. So it was not reported. So various reasons, this 2 out of 5 lakhs, 2 lakhs was not reported. Now they are expecting that reconciliation to happen in this table. Total sum reported in 10BD. Then donations reported in form 10, not reported in form 10BD. What are them? And under that classifications. One is it because it is received as a corpus donation for ATG2B. ATG2B is corpus, the donation received for the repair, renovation, etc. of the religious places like Gurudwara, mosque, etc. Is it that category? Or another one, donations received by the trust or institution which qualifies for ATG. It is qualified under ATG other than this kind of donation. Which one? This repair innovation donation or ATG 24. ATG 24 talks about any fund or institution which has approval under section ATG. So have you received any donation which was actually to be reported in 10BD, but it was not in the nature of corpus donation for repairs and renewals. It was not falling within the donation for which there is an approval. Then have you got anything? Then you have to report, and it was not reported in 10BD. Then third category, donation should have got reported in 10BD, but it was a cash donation in excess of 2,000. As you know, there is a mandate that the recipient organization should not take actually more than 2,000 rupees cash donation should not be there. So that the person is not eligible to for ATG benefit, right? Then donation received other charter. So here out of the accumulation, see there is one mandate under section 11 where they say in my examples I told you, where the organization has not spent money and they will accumulate, they will commit to the department that they will spend it within next 1 year or 2 year or 3 years. Now from out of this accumulation, what has been committed, they cannot give a donation to another organization, right? They cannot give. It is a violation. Now with the in this context, I have to tell there is a major amendment in Finance Act 2023 about charitable organization donations, where they have plugged the downstream donations. Since that is not a subject for today's discussion, I didn't include, but it is a good idea to know it. So please go to that amendment in section 11. So where they have plugged the downstream donations. So it is not eligible for deduction. Why? Because it was given out of accumulation, means then that will come. So this particular 22.2 is a case where it was a donation, but it is not in compliance with some conditions, so it is not reported. Then donations which could not be reported in 10BD due to non-availability of the details. That is one category. Then donation received in kind is another category. Donation received in kind. Then 115 BBC. This is anonymous donations. Very, very important. Anonymous donations are taxed at 30%. There is a rule, total donations. Out of the total donations, gross receipts, then 1 lakh or 5% of the gross receipt and amount in excess of that is taxed at 30%. 115 BBC, there is specific provisions. Please understand the provision. So anonymous donations are taxed. 5% of the total donations received by the SSC or 1 lakh. So whichever is higher is allowed, and amount in excess of that is considered as anonymous donations. Please go through that section. They are asking that specific type of donations, if any, has to be reported here. Then any other voluntary contribution not forming part of 10BD. There is a voluntary contribution but not reported in 10BD, but not falling in any of those categories. One example I can think is foreign contribution or government grants, or some workshop was conducted where people gave a donation, but they never gave, they gave name, address, everything, but we had a situation where the donor told that please don't give me ATG. He doesn't want ATG, and he told please specifically don't include in 10BD, like that. So anything is there will come here, and that totals up to the total of 23 from 1 to 7, 8 totals up to the total donations, though it is voluntary contribution not reported in 10BD. And then 24 total voluntary contributions received by the auditee during the previous year. So 22 is what is reported in 10BD. 23 total is what is not reported in 10BD. That should actually total up and match with your voluntary contributions reported in your ITR, in your receipt and payment, in your computation, your gross. Then out of next question, specifically they are asking total foreign contribution out of the voluntary contribution. Precise question. Now the full reconciliation you are expected to do and sign in your audit report. Then voluntary contribution not forming part of the corpus with that classification. What corpus received for repair, renovation and other corpus. Then from there, if you fill in all the information, finally it will give you the number where voluntary contributions required to be applied by the auditee during the previous year. So this automatically this will get populated once all the numbers are captured. You should actually match with your computation in the ITR 7. Then income to be applied. This is income other than voluntary contribution. So here up there, this table takes care of all your reporting for voluntary contribution. Then income to be applied, voluntary contribution other than voluntary contribution if you have received from any property held under trust, like your sale of land or any minor consultancy incomes or maybe interest income, rental income, all those things will come here. Then any income has been applied outside India. So this is a violation we discussed. But this is, sorry, this 11(1)(c), I'm sorry, income applied outside India which is eligible under section 11(1)(c). 11(1)(c) talks about the expenditure for international welfare. This is a specific exemption for specific organization for specific projects. Most of the organizations may not have it, but this particular section is only for promoting international welfare. That is the only context in which under section 11 amount can be utilized and it is not a violation. But that is a very rare situation. Other than that situation, the actual activity has to happen in India. Then amount of, then here other up to this income is captured, then comes the application. Here you see the where the information is expected to be reported. Left side it says precise activity. This is the 6 limbs of charity, charitable definition under 2 subsection 15, religious, relief of the poor, education, medical relief, yoga, preservation of environment, monument, advancement of utility. Then one new thing, application which cannot be specifically categorized. Then total application. Here you see they are expecting us to certify the category in which it has been spent, electronic and other than electronic. Now, what is electronic? There is a clarification in circular 6 bar, in circular number 6 to 2023. There is a circular which I told you in my slides, which is very important circular, which gave a lot of clarifications, where they say electronic mode includes debit card, credit card, UPI payments, all those so on and so forth. That is not the real challenge. The real challenge is there could be a situation where there is the activities of the organization will involve a lot of field work, where people will work in rural areas or in forest or some villages and all, and the activity involves a lot of field work involving labor. Now, from the organization is concerned, there will be a principal person, a project coordinator or a manager who is one of the employees, and project advance will be given to them, which will be a entry in the bank account, debit project advance, credit bank, right? It will go to the, sometimes what happens, they open a separate bank account of the organization, not a problem. Sometimes what will happen, they transfer to the specific bank account of the project investigator, which have a different timeline for settlement of advances. This money will go as a bank transfer or through a check payment, and the person who executes the project will be drawing the money and paying the money in cash, right? Now, when we do vouching, we will see advance settlement. There will be cash vouchers with people's signatures. But as far as books of accounts are concerned, there will not be any entry in the cash book. It will be debit project advance, credit bank, and next advance settlement is a journal entry, right? Now, in this case, other than electronic, actually speaking, the final disbursement in the field is in cash. As far as it is a organization's money only, it is organization's expenditure only. You can't disown it. It is organization expenditure deployed in cash. Now, is it possible to get this information from only the audit of books of accounts? Even from vouchers, how can you expect the whole year's vouchers, cash vouchers? You can't take because the cash entry is not in the books. So here, in my view, we may have to take a stance, and just like we give in 3CD report, we may have to give a disclaimer saying that this information is not available for our verification. We may have to give a disclaimer, and what stance has been taken has to be clearly communicated to the officer. If there will be an option to attach the financial statements, along with that we may have to give a separate page of report, or if observations column is not enough to write this, we may have to give this. This is, and more important, that is our disclaimer part. More important, to get this information, now you have to catch the accountants, because they will give the total payments from the books. Now you have to, if at all there are cash payments, you may have to take this information. There will be actual cash payments also. One example I told you is an issue, but normal cash payments will be there, which is allowed within the limit of the 10,000 per day limit and all. That information has to be captured in this format and reported. This all involves a lot of work. So this is application of income. The rest of the data is pretty straightforward. They are asking for payment in excess of 50 lakhs, perhaps for that TDS compliance under 194Q. Maybe it is for that. Then actually paid. So here you see amount which was not actually paid during the year. That will be one of the deductions. So first they captured full voluntary contribution. Next, all the critical questions about application of income they are asking here. Which was not actually paid during the year, amount actually paid during the previous, but it was accrued earlier year and considered as application. Total amount allowed as application. They are minusing that other two. See, 3 is minus 31.3 is minus because it was not paid during the year. Amount actually paid during the year, which actually accrued during the earlier year. This is answering one of the questions which I had in chat box about payables. So last year it was a payable entry, it was a journal entry, but it was paid during the year. So it will come in your receipt and payment account. That will be considered as an application in the year of payment. And versus amount accrued in this year but paid in the not paid will not be considered. And then bifurcation of revenue, capital. Then here, these two questions as far as the utilization from corpus and utilization from loans and borrowings and whether you have put it back, that question is asking. That is why that amendment is relevant. Deposited back, it is asking. And finally, disallowances from application. These are specific disallowances where TDS has not been complied as per that provisions of 40A, which is relevant for business chapter, has been brought in here, mutatis mutandis. So where TDS compliance has not been done, there are specific disallowances. Then 40A3, cash payments in next of 10,000 per day. All those specific disallowances, they are and as I told you, from accumulation, if they have paid a donation to another organization, that is a disallowance. All these disallowances are captured here. And finally, amount application outside India. Then application for any purpose beyond the objects of the auditee. Any other disallowance, total allowable application. So from all this, the disallowances are removed. Here donation, if you read the section, donation to any fund or institution or trust or university, etc. towards corpus. So if you give any donation toward as corpus donation, it is not allowed as an application. Then you are giving donation to an organization not having the same objects as this donor organization. This is a specific violation. You can read the respective sections. It's quite lengthy section. That's why I'm not explaining. But make sure that you understand these violations. If they are making any payment to payment in the nature of donation, your catch is like if any donations are paid to another organization having these specific registrations or any donations having no registrations, we have to be more alert and we have to see whether it will fall in any of these specific disallowances. And from there, after minusing all the specific disallowances, total allowable application he is arriving at. And here he is saying, here finally after doing this, you will get the numbers where you have not spent 85%. Here he says, whether the amount deemed to have been applied under explanation to 1.2 subsection 11.1. This is the option, form 9A case this is. And 11.2 is form 10 case. So if you have not met the application mandate of 85%, you have to submit either form 9A or form 10 depending on your situation. And after this balance will be 15%. If you have not spent 85%, you can get a 15%. Suppose you have spent 90%, then that 15% is not there, only 10% will be there. Suppose you have spent the whole receipt, then you don't have 15%. That will come as a part of the computation. Then taxable income. If any violations and disallowances, if any money comes, automatically you will have a tax liability here and 115 BBI will kick in. So as I told you, once you fill in the number which has attracted any violation or any disallowances will be subjected to taxes under section 115 BBI. And 115 BBC is anonymous donation, taxed at 30%. So that computation is like 5 lakh and 1 lakh, whichever is higher, and amount in excess of that, the differential is considered as an anonymous donation. Any other income, the auditee has any income chargeable under section 12.2, the amount of such income. So under section 12.2, there are specific situation of income which is subjected to tax that we have to report here. Very unlikely people will have this. That specific provisions, if they are attracting, has to be reported here. Then 11.1.3b also, it's relating to the corpus donations. Explanation 3b to section 11 violation. So this is violation, other income. 3A to 11 clause B of section 80G violation. So this is actually regarding the corpus, if there is any violation, that has to be reported. So if you fill up the schedule in corpus, if you fill schedule corpus, There they were asking the bifurcation of corpus, no? The amount flows in from there. Even see 80G2, even the 80G2B. 80G2B is corpus donation towards the repairs and renovation of Gurudwara, etc. And finally, this basically all these are other income which may be subjected to tax under section 11(4). Then capital asset, any purpose, have you bought any capital asset? Specifically, they are asking property held under any transfer. If you have transferred, whether there is any sale of the capital asset forming part of the trust, the mandate is like that money has to be utilized for the objectives of the trust, or you can accumulate it. Then application of income of different sources. This is another major reporting requirement where this was there in the last year in the ITR 7. It is nothing new. As I explained when I was explaining ITR 7, total application, out of the total application, from which source have you spent? Is it from the current year corpus? Is it from borrowed funds? Is it from current year receipts, or from accumulation, or 15%? And depending upon the mode in which it is being received has to be reported here. Then 1310 is again violation, repeatedly that is coming. The same questions asked in ITR 7. So as I told you, most of the questions are repetition from ITR 7. Then expenditure incurred for religious purposes. If you have anything, you have to report here. Then specified person. As I told you, specified person, so much reporting they are asking. Whether any rent paid to them, whether any salary paid to them, whether is it in excess of the services rendered, what is the category of services rendered. Very detailed questionnaire is there. Any shares has been transferred. Whether any income or property of the auditee is diverted to the specified person. So many questions. All questions are pretty straightforward. There is no interpretation. You can answer these questions. If you have these questions, has to be discussed with the client. Then specified violation under the respective sections. If any of these violations the client has attracted, it has to be reported. This is another new table where no, this is a corpus table, details of corpus donations. Then another new table which I wanted to show is that then details of foreign contributions, straightforward, details of loans, borrowings, details of income applied outside India. These are all schedules. So the questions were up and the schedules are following. Deemed income application. See, these are the same table we saw in ITR 7. So nothing new here. That's why I spent time in ITR 7 table. Same, most of the tables are more or less the same. See, details of accumulated income tax earlier continues to be here. Whether any part of the income or property of the auditee is lent or continues to be lent to the specified person. These are all details. If any property has been let out, as I told you, let out to one of the property is belonging to the trustee, or if the property of the organization is let out, that is the situation. If the organization has a property and it is let out to a specified person, and organization is whether getting rent or not, that question, their PAN, all those details they are asking. Then details of any service of the organization. So here, if the organization has rendering any service, any of those services were made available to the specified person. Then immovable property details. These are all straightforward. One important thing I want to tell, just like the 3CD table, just like we do a tax audit, in tax audit annexure, we do a reconciliation of the TDS liability, the same table they have brought in this audit report. Okay, that is one important thing. So please allocate your time. Then another one table, this is not part of ITR 7. Please closely follow this. Just like we last, the list of pending litigations when we do a company's audit, schedule of other law violation. So this is very important. You have to ask whether there is any notice or any other litigations going on under PT Act or FCRA or anything. This question, don't forget, this is not a part of ITR 7. Then this is the table, TDS reconciliation. The table questions are more or less same as the one in 3CD annexure. Nature of details of payment on which tax is not deducted. So this table will give the answer for disallowance under section 40A. Then 40A3, more than 10,000, 40A3A payment to creditors, 216 excess, loans, borrowings in excess of 20,000. Pretty like our tax audit. It is as good, as similar as our tax 3CD report. This much reporting requirement is there. And finally, we come to the end. I think some instructions they have given here. Yeah, some explanations. So here, Your focus, or rather our focus, including myself, will be to closely follow the sections which are in the nature of violations, section 13.10, and the donations which are not allowed as deduction, section 12.2. And section 13 specifically talks about the situations where section 11 benefit is not allowed. It has many clauses up to section 11. That section 13 has 11 subclauses. Please go through all those sections. We all have to read little more seriously section 11, 12, and 13. And those people who have audit of the organizations having approval under section 10, please see the section. They have specifically referred to that section in that question. That is why actually I wanted to show the section, but for want of time I am limiting this. But I'm sure as chartered accountants that reference of section is there. So section 11, 12, and 13 very critical. Identify the disallowances, allocate your time to do the audit, and let me see if I can quickly take any more questions. Any critical question which we have not addressed? Less than 2.5 lakh income, which form need to be filed? If 12A registered trust is having less than 2.5 lakh income, audit is not mandatory. If they have approval under section 11, 12, then ITR 7. If they have no approval, ITR 5. Yes, ITR 5 MMR taxes need to be paid because shares are indeterminate. If shares are determinate only, basic exemption limit you get. Then I'm seeing whatever questions coming in front of me, I'm answering. Those questions not answered, please Deepak, these questions can be saved in and shared to me. I'm ready to answer if it helps. Whether renting, if people can wait, I can quickly answer the questions. Is it okay? Under 10 minutes?
That should not be a problem, madam.
Yeah, let me try to answer as much as possible for the benefit of people. For branch of a trust, whether a separate audit report in Form 10B or BB is to be issued, one PAN number means I don't think so, because this is not like GST. In case of GST, branch will have a separate GST registration. Since there is only one PAN number, I don't think there is a need for separate audit report. Once Form 10 filed for 1 year, whether need to file Form 10 every year, even though second year were accumulated? No need. Once you have committed for an accumulation for 1 year, you have to, like a FIFO method, you have to make sure that accumulation is utilized. New Form 10 is for new accumulation only, not for the earlier one, even if it is continuing. Then in the third year we spend amount, then we file Form 10. Is it correct? So new Form 10 for new accumulation. I think I answered that. Section 8 has received a grant from central government and the grant amount should be used for promoting incubators. I think I answered that question. Then can we get this? Can trust accept unsecured loan from trustees or give unsecured loan to trustees after charging interest rates prevailing? So trustees can give loan to 69 SS, that reporting requirement we saw. Given loan not recommended because exclusively because of that reporting requirement. This only they want to avoid. Any transactions with trustees, directors, others, that specified people under section 13(1)D is under observation. And now this time audit report has a very detailed question. I'm sure one of the question is this, so that question is answered. Then visible now. Can you elaborate, sir? Very good questions are coming. We are all interested in part of discussion. Can we have this question in case? Okay. Can you please elaborate what is application outside India? Is it no, traveling outside India is not. You have to be very careful because in ITR 7 they ask travel, foreign travel. Make sure that number you observe, and you have to ask a question to the assessee that travel is only part of executing a project which is run in India. Execution should not be outside India. Under clause 31(10) of 10B, donation to any person other than 1023C or 12AB institution is disallowed. That is not clear. Can you substantiate on this? This is downstream donation. Donation to any person 12AB institution is disallowed. It is like if it is not incidental to the objectives. If it is not incidental to the objectives of the organization, you cannot consider it as an application. If you read section 12 and section 13, they have specifically listed about it. Client has transferred amount to an international organization with a different objectives. Will this not be considered as application? What is the purpose? Purpose of sending money? You have to ask the purpose. All VC voluntary contribution should be one bank account as per approval 12. Not necessary. It is not necessary all the voluntary contributions should be in one bank account. Maybe perhaps your question is from FCRA point of view. There, what they say is, if you have an FCRA approval, the donations received from foreign source, or rather voluntary contributions received from foreign source, including grants, donations, anything, should first come to your designated bank account, which is SBI New Delhi. It has to, the first point of receipt should be always designated bank account, but from there it can be transferred to other bank accounts for utilization purposes, depending upon the requirement of the donor. Sometimes some donors insist that their project has to be, all the activities of the project has to be executed to a separate bank account opened. But FCRA donations, FCRA receipts, you have to be careful. It has to hit the designated bank account. There is no such restriction as well. Indian accounts are concerned. Indian donations are concerned. It is a violation, sir. There is a 12AB. You can read that section. If books are not maintained under the 17A or ITR not filed, 12A1AB, there is a specific provision where approval will have a problem. Details of transactions referred to in section 13 to salary allowance state person out of resource of the trust or institution. Reasonable. So now the question of reasonable is not defined. So here you have to have enough documentation. See, for example, if it is a research organization, the trustees will be mostly scientists. They will be taking salaries or they will be executing the projects. Make sure the qualification and what part of the project they are executing. There should be documentation. One of the scrutinies which we face, the officer asked us to explain the activities, what is actually done by the trustee. So to that extent, there should be you have to do a study as to what see, you should make sure that he is not getting a remuneration which is not at par with the market rate. If a non-trustee has been employed to do the what salaries you would have given, same salaries, arm's length you have to follow, sir. And then income from building on in the name of the such income is utilized for providing scholarship to students. Is it charitable in nature? What is the objective of the organization? Now it is income from property held under a trust. So there were case laws and decisions made. You might report under the respective head, but if it is utilized for the objectives of the trust, it forms part of that 85%. Now, fundamentally, what is the objective? If it is under precise limb, that 20% may not attract. You have to see the specific case. Basically, applicability, if it is objectives of the trust, if you are not violating that 215 provisos, then you should be able to enjoy the exemption. Is diverted during the, can you explain with examples? Diversion means, see, if it is a grant received, there is a proposal to give a grant to the organization. Instead of getting the money in the bank account of the organization, the money goes directly to one of the persons associated with the organization. Such things should not happen. Or even interest income. Project is executed by a person in the organization. Any interest earned out of that project money should not go to his personal bank account. See, in this context, I want to tell, especially project advances given. See, what happens is, most of the organizations we recommend when they have field activity, open a bank account of the company, of the organizations that place, and transfer the money bank account and give them ATM card to operate. But in those cases where it is not possible to have a bank account and they are transferring money to the personal account of the people who are executing the project, there should be a strict advance policy for settlement. You have to, when you do the audit, from audit point of view, please go through the advance settlement letters, and please question those advances which are pending for a long time. What is their advance policy? Most of the organizations which I have come across have an advance settlement policy of 1 week, 3 days to 1 week, unless it is a specific case where the project is being executed at some Himalayas or some other place where the person cannot travel for 1 month. In those situations or exceptional situations, the advance policy has to be very, very robust. Otherwise, any time the officer can ask for a data, and if he sees that long pending advances are being there in the personal account of the people, it is a problem. So he can say that income is diverted. Imagine somebody getting 2 lakh rupees on 1st of every month and he settles only next month. 1 month he is going to utilize that money. The actual utilization is happening very less. So please insist on a very robust, if some organizations they don't have it, please recommend to have a robust advance settlement policy, and otherwise it should be it can be considered as a diversion, because as it is they have not defined what is diversion, sir. That is why they have brought in as a part of our audit reports. We as auditors, we may have to apply our general audit judgment skills and our standard auditing practices and all assurance standards and all to identify what is diversion. A charitable trust can run a religious program. Many visitors give donations. Program was over and they all could not be traced. Now, how to get the details of PAN? So this is a case where you can see now what happens in 10BD. You can have reported. Now we have to report where data was not available. If too much money means, he will tell it is anonymous donation. It is anonymous donation, he will constitute. It is not a religious trust. Only for the religious trust, anonymous donation, there is exception. Not for public charitable trust, other than religious trust. Whether maintenance of Goshala will come under charitable purpose, if so, under what? So, maintenance of Goshala under the head, see, it is not relief of the poor, medical relief. Preservation of environment, very unlikely, because there is no preservation. It will fall under general public utility only, sir, in my view. Madam, is GST registration required? I was expecting this question. GST registration actually, since that quickly I'll tell. GST registration, there is a notification 12/2017 where there is a different set of definition for charitable purpose. Just because you have a 12A approval under Income Tax Act, don't think that you have GST exemption. They have to do the activity which falls within the definition of charitable purpose for the purpose of GST. You have to read that 12/2017 notification. Then even in that, there is a flyer for the people's understanding. There is a flyer by CBIC where there is a specific explanation as to, even if it is a 12A entity, if they carry out any activity which is in the nature of quid pro quo. For example, one of the questions was they have a chowdhury or they are letting it out on rent and they are getting a rental income. Even if the entity is a 12A entity, even if it is charitable purpose, that rental income will be subjected to GST. And all the authority for advance rulings are giving adverse rulings. They are not in favor. So GST registration, because if there is GST goes by supply, if there is a consideration, see, as I told you in the beginning of the session, the mandate is there should not be quid pro quo, there should not be consideration. But if the organization is running any activity which is in the nature of quid pro quo, for example, I told you they conducted training, outreach activity, and they gave food in that, and they collect money for that food. GST authorities will say that whatever money you collected for that food is not a charity. There is no charity there. There is a supply of food. You collect money and apply, get it registered. And as far as GST registration is concerned, for registration, grant as it is, there is no quid pro quo, so it is outside the purview of GST. Without grant, if your receipt exceeds 20 lakhs, then you might get into GST registration. This is the view which we have been hearing from experts and we have come across. Grant is outside the definition of outside the purview of GST because it is not, there is no supply. So without grant, if the organization, if your client is carrying out any activity where there is a quid pro quo, including say reimbursement or not on actual basis, because under GST reimbursement there is a concept called pure agent. Most of the cases they may not follow, they may not comply with the conditions applicable for a pure agent. So even that can attract GST. This is the general view on GST applicable to these organizations. Trustees having FCR registration not received any foreign contribution during the year, total turnover is less than 5 crore. However, earned some FD interest in FCRA account, still Form 10B is applicable. I suggest you go for thing because foreign contribution includes that interest. Better safe side filed Form 10B, sir. 10B recommended. 10BP report quickly. I wanted to show that form, but it's a very simple major point to discuss. It is pretty simple, straightforward form. So it is a 6-page form. Specified person, whether all the relative persons is specified. The relative definition is defined for the purpose of section 13, sir. You can go through that, just like section 56. For 5 years, after 5 years, it is not able to apply the whole or accumulated income, whether non-utilized accumulated income will the income of the trust can trust. No further period of extension, no sir. As per the section, it is a taxable income. Now, if you want, you have to approach condonation. As far as I know, they have not given. You may have to talk to the commissioner. From the book, no, it is income. Then, what are the other questions? Details of transactions and income, property, OT diverted, I told you, books of accounts, donation, transfer. Somebody had asked me about that donation. No, see, donation paid from accumulation. See, you would have committed to spend. One of the examples I am giving you for the benefit of audience. Downstream donation, see, you would have committed to spend for objectives of the trust in the next 5 years. Out of that, if you give a donation next year, no, donation out of the previous accumulation is a disallowance. That could be one situation, even if it is not for objectives. That was one of the questions. That could be one example of disallowance. One client has received donation from international organization. We have not considered this while filing Form 10BT because they do not have statutory presence in India. However, we will consider this as donation while filing in which case donation as per ITR and Form 10BT does not will create any issues. So that reconciliation will save you. There will be an audit report, right? So it is a donation, it is a voluntary contribution. You have the mandate to spend 85%. But in 10BT reconciliation in your audit report, it will come. Any voluntary contribution not reported in 10BD, others specify. There you have to mention this details, Radhika. This is Radhika, but you mention that details and it will be fine. Then, is there any restriction on spending 15% accumulated? No, no restriction. 15% you can use. Can you elaborate what is the application outside India? That I answered. In case of temple, as far as my understanding is concerned, religious organizations, anonymous donations are not subjected to tax, is my memory. Only collections. And now, any more questions, Deepak? Can you see? I have answered, not answered.
I think you've answered all that is there in the chat box. There are a couple in the Q&A box.
Yeah.
Whether maintenance of Gosala will come under charitable purpose. If so, under what head of 2 clause 15?
I have answered. So, if you see that specific claims of charity, yeah, I have answered that. Q&A 16. Let me open. Yeah, I think I'm seeing Q&A only. Please share the screen, madam. Not visible. Section 8 company waiting with questions. Is there a restriction? Application outside India, I've told. 12A. Can 12A entity have more than 2 objects? Are there in no restriction? At the time of renewal application, you should mention that both limbs of charity, medical relief and any object of general public utility, like that, or preservation of monument and general public of utility. See, for example, for preservation, they are preservation of environment, they are planting trees, and any object of general public utility, they are doing something else, they are selling something like that. I mean, it is possible. Rental income, trust is having FCR registration. How to get recording? That KSCAA has to answer. What will be the permanent fund? I have answered. Then what will be? Yeah. So there is no permanent fund. The permanent fund word is the word which you have coined. What is the nature you have to identify? Is it a corpus fund or a general fund? If it is a general fund, no problem. Corpus fund, that restrictions apply. Can't be used for daily expenses as it is. If you use it, you have to put it back. Yes. You can share my my email ID or phone number. If anybody has any questions, please ask by WhatsApp. I will try my best to answer. Yes, I think I am done. Can we wind up or? any more questions?
There are none left, madam, now.
Okay.
So
So I sincerely thank KSCA for this opportunity. Some of the questions are thought provoking. Again, I'll go back and read. As I told you, section 11, section 12, and section 13. It is we will get different perspective every time when we read. With some of the good questions, again I'm going to read. So if I have any different answer or opinion, I don't know. I mean, maybe our understanding will go better. And at this point, first thanks to KSCA and Deepak for giving me the opportunity to handle this session. I read with more seriousness ITR 7. As I told you that I tried reading in the system, but I thought it was not enough. So to taken a printout and also please all of you do that. It was very helpful. And I have to express my deep gratitude to my partner and my guru Rekha KR. Rekha ma'am, because whatever I have deliberated here today is what I learned from you, ma'am. Thank you so much. And thank you all. Thank you all for the patient listening and participation, because this is a virtual seminar. We don't see the audience. So without participation, we don't get encouragement to talk. So many thanks for the people. I have exceeded the time. Thank you so much. I am sorry, the time limit is out. I'm sorry. Thank you so much for the participation.
Thank you.
Madam, do non-ETG donations need to be reported in? So 10BD, that is a good question. Last question. 10BD, actually, first when they introduced last year, even our understanding was only where people are claiming 80G, we need to report in 10BD, because we thought that it is like 26 AS. It will get reported in the 26 AS, the 10BE and all. But from this reconciliation, when they have introduced, I think as far as the recipient organization is concerned, you don't go by whether you are doing 80G or not. Bring all your voluntary contributions in 10BD, and whatever not in 10BD should fall in that category which we saw in the audit report. Yeah. So anonymous. So bank is not able to give details, name and address. At least you should get it. No name, no address, no PAN. Definitely, officer will consider it as anonymous donations. Unfortunately. Yeah. Thank you.
Thank you, madam.
My phone number you can share. Email ID is raninr.ca@gmail.com. raninr.ca@gmail.com. Please mention in the subject line that you can address to this conference so that I don't miss the question. And my phone number maybe 9449851762.
Thank you very much, madam. I take this opportunity to extend a formal vote of thanks to our speaker. On behalf of Team KSC and all the attendees, madam, we thank you for your insightful and delightful discussion on trust-related forms and reports. Thank you for having consented for the program and having devoted your time. We also thank the attendees for their participation. Thank you all. The session stands concluded. Thank you.
Have a nice weekend.